money and worry, in addition to being rhyming words, are two sides of the same coin. If we don't have money, we worry. That's understandable. But at the same time, we also worry when we have money, especially if this money is invested in the stock markets, and especially at a time when all one can see for miles and miles is chaos and confusion. In the year 2020, we saw a massive stock market dip for which most investors were unprepared for. So in this video, we shall look at 7 responses and strategies that investors can apply in case another stock market crash comes along the way. With that being said, let's begin with the first of the 7 strategies. When the market crashes, selling off one's stocks and equity holdings is very tempting. And why would someone not want to do that? After all, there's a pandemic, there's an asset bubble that's just about to explode, there are scams being revealed. I mean, there is enough negativity to influence any investor. But what history shows us is that the best and the worst performing days often cluster around the same time. Like this table here that shows the Nifty 50's best gain days as a percentage and its worst loss days again as a percentage over the last 20 years. Notice how in 5 of these years, that's 2001, 2004, 2005, 2008 and most recently in 2018, the gap between the best and the worst days of the year for the Nifty 50 was within 7 days. That's just a week between the best and the worst days. And then in a total of 10 of these 20 years, we see that the best day worst day gap is within a single month, which also kind of explains why timing the market stuff doesn't typically work in most years for regular investors like you and me. So remember, fear always leads to panic, and it is in this panic that amateur investors end up selling their investments at depressed prices. But what is also true is that panic always gives way to recovery. It's happened not once, not twice, but every single time. So if you don't do anything and simply allow for your SIPs to continue, when the dust settles, one would see that your investments would have still done really well. In fact, in one of our videos, we had settled this time in market versus timing in market debate and shown how even the worst investor would have made returns of over 12% per annum in spite of having bought mutual fund units only in those months when the stock markets were at an all-time high. If you haven't watched that video, I'll have a link to that in the description below. And if you're looking for a trusted platform to start a new SIP, then do download and explore the ETMONEY app, which offers over 1,000 direct mutual fund schemes to invest in and is the preferred investing platform for lakhs of SIP investors. Now, I'm not telling you to not buy equities, but our intention here is to curb your enthusiasm into making panic buys. Now, you must be wondering, what is a panic buy? Let me explain. When markets tank, the eyes of many investors light up, and the common approach here is to buy some index funds or invest in some blue chip companies. This may or may not be the right thing to do, and something that we'll discuss a little later. But one area that everyone forgets in these moments is to remember one's appetite for taking risk, which means even the most hardened conservative investor who prefers to have 90% of his or her wealth in non-equity instruments tends to abandon the risk profile and ends up investing a more than normal chunk in equities without having the temperament for it. And that's what we mean by a panic buy. It's a state of mind that pushes you to lap up whatever one sees, which completely messes up your ideal investment path. Now, the right way of going about this is to plan before the market tanks. And the plan is for you to know what is your tolerance limit of moving your portfolio from low risk assets like debt to high risk assets like equities. Is it 5%, 10%, 20%? Simply speaking, it is in your interest to know your risk tolerance so that you are less panic stricken when the market tanks. Rebalancing is an investing strategy which helps reduce portfolio risk and in most cases offers better risk-adjusted returns to the investors. This is done by buying and selling portions of your portfolio in order to set the weight of each asset class back to its original state or the targeted allocation, which means one needs to have a targeted allocation or a plan to begin with. And if you don't have one, then a stock market crash can be a wonderful time for you to take stock of your financial situation. This would include things like what assets do you own, like equities, bonds, mutual funds, gold, etc. How much do you have? What are your financial goals? And more importantly, how do you want your portfolio to be built up? So are you seeking some consistency in returns or don't mind massive volatility for the next 5 years, etc. Once you have these things in place, that is the target allocation in place, you can then figure out where you stand and how much of buying and selling you need to do. Net, rebalancing helps in not only preserving your investing style, but does an excellent job of managing portfolio risk, especially at a time when the markets are choppy. Having said this, there is one important tip we'd like to put forth here. A good time to rebalance is perhaps not when the stock markets are in the middle of a storm. Hence, a suggestion for investors is to give the market some time to calm down and then proceed with rebalancing of one's portfolio. A fall in the stock markets can be an opportunity to indirectly increase your post-tax return on investment by using a tax-saving technique called tax loss harvesting. Now, we all know that profits from buying and selling of stocks or mutual funds is called capital gain and some tax is payable on it. In the same thread, when you sell stocks or mutual fund units at a loss, you accumulate what is referred to as a capital loss, which means much like how one needs to pay tax on capital gains, one can also save taxes on a capital loss by offsetting it against a capital gain. It's a technique that is commonly used by investors, especially during the end of a financial year, most prominently in the months of February and March. However, the tax loss harvesting strategy can be used throughout the year and should definitely be used when the stock markets tank, and that's because this technique serves as a great way to offload some of the weaker stocks or funds in your portfolio and to replace them with potentially higher growth funds and securities. Additionally, it is also recommended that when investors rebalance their portfolios, they should simultaneously consider tax loss harvesting in their calculations, as it will visibly help in reducing one's tax outgo in addition to improving the asset allocation mix. There are some interesting ways in which investors can use tax loss harvesting, and if you want to know more, then do check out the blog article and YouTube video we have attached in the description below. When stock markets fall rapidly, there is a lot more at stake than just the value of one's portfolio. After all, the financial markets have an impact on the employment market, the real estate market, the general consumption of goods, bonds, inflation, and many other areas of society which might seem like a complex entanglement. Different people would be impacted differently, but what can help to some extent in such situations are a few basic things like 1. Create a personal cash flow statement. A cash flow statement is a record of all money that comes in and all money that goes out. Having this accounting ledger for yourself is a great way to organize one's finances and to also ensure that a stock market drop is not messing up with your utility bills, tuition payments, rent, and other essentials. Additionally, keeping a track of your expenses will also help you reduce the more extravagant expenses like expensive dinners, unused gym membership, a day in the spa, etc. A second requirement to protecting oneself financially is to have an emergency fund. So if you don't have an emergency fund, start one immediately. And if you have one, then a stock market crash is a good trigger for you to top up that fund with an additional 2 to 3 months of expenses. And the third area that one needs to look after is about managing debt. As a rule, a big stock market fall is not the ideal time to take any new debt, as you don't want to be caught in a critical economic situation. Further, this might also be a good time for you to refinance your existing debt like a home loan, personal loan, or credit card, especially if you are in a position of power by having a good credit score. Yes, equities are relatively cheaper, but it's still important to look before you leap. The first area one can attack when equities are available on the cheap is to go after the long-term investment accounts. I'm specifically referring to any money that you have in NPS or ULIP accounts which are long-term in nature, that is, they come with a multi-year lock-in. It's in these instruments that you can seriously explore switching from a conservative asset allocation to a more aggressive one by loading up on equities. After all, history is proof that equities, and particularly when they are bought at delicious valuations, can really boost up one's retirement corpus. A second area of interest to many investors is to lap up stocks and mutual funds in the event of a market fall. Yes, a big stock market fall can be an opportune time to invest in stocks and mutual funds, especially if you are adept at identifying pricing mismatches and bargains. For instance, if we take the larger universe of Indian stocks, that is the Nifty 500, we see that this index has gone up by 75% over the last 1 year. That's a pretty big jump. But that doesn't mean that everything went up. In fact, some popular names like Yes Bank, Bharti Airtel, United Spirits, and Abbott India actually gave negative returns over the last 1 year due to many factors like valuations, growth, etc. So the point is this: it is always better to research and be ready with a watch list of securities before the market tanks, so that when the market tanks, you can take buying positions in potentially high profit investments. But if you don't know how to value stocks, then you're better off utilizing the services of a professional fund manager using a mutual fund framework, a lot of which is available on the ETMONEY app. When stock markets tank, there are bound to be some hard questions. Will the stock market go down to zero? Will the economy recover? Can stock prices grow from here? And like clockwork, these questions are presented every time some economic calamity happens. And like clockwork, stock markets don't go to zero, the economy always recovers, and yes, the stock prices do grow and reach new highs in time. But yes, there will be some short-term pricks, but how that matters to you depends completely on you. And that's because if you're aiming for the long term, then no amount of watching the news or reading advice on WhatsApp should be of any consequence to you. So the smart thing to do for long-term investors is to keep a level head and not watch the market too closely. Instead, watch out for your own behavior by resisting the urge to do panic buys and panic sales, making sure that your portfolio is rebalanced and that you are taking advantage of tax laws, protecting your cash flows, and most importantly, understand that volatility is an important part of the investing process, and there will be many more stock market dips in the future. And with this, we come to the end of this video. If you are an existing ETMONEY investor, we sure hope you are enjoying the new home screen our team has put together after sifting through hundreds of customer feedback and interviews. The home screen looks fabulous with smarter and faster navigation and an all-new Learn section that features our most popular blogs and videos. Once again, thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.